What's up, guys? Welcome back to G-Tech Finance. Hope you're doing. I hope you're staying safe. Well, folks, the good all might be upon us. Why? Because of a very stupid reason. And it's a stupid cargo ship getting stuck in a canal. Why would I be so pissed off about it? Because what we have been talking about on this channel, we've been talking about, well, obviously the market's going nuts. This massive fear over, oh no, bond yields are going up. Yeah, come on, tech stocks. Take it. Rah. Yeah, they get beaten up, they go down. Short-term increase in the bond yields means maybe inflation's coming, just maybe. But no, us, we should just sell everything, rotate over to recovery stocks, let tech stocks get beaten up like there's no tomorrow, and then we're just out of everything because inflation's come, and we all think so. At least I certainly think it's a fraud, fugazi, whatever. So inflation long-term, Jerome Powell has said it, and I personally, in my humble opinion, I do agree with him that we might see short-term spikes. That's not out of the equation at all. But long-term, it will average 2%. I mean, for like 45 years, American inflation's been going down in America. Why would it change now? So I think it is, in fact, I think over the next inflation readings, they will continue to have lower and lower readings because, as we saw, the CPI data are coming low. And today in the personal consumption expenditure, it came in 1/10 or like 1% lower than expected for inflation. And this is the data the Fed uses. We like to hear also the CPI, Consumer Price Index. This is the personnel consumption expenditures. It's kind of the same thing. Now it basically came much lower than expected, month over month. Should be a good thing. The stock market should be happy. More confidence, right? No. It just beats. Bond yields go up for a bit, then they just beat up the tech stocks. Massive sell-offs. Tesla goes down 4%. NIO goes down 4%. And yeah, that's basically what happens. So, I'm expecting, in fact, the next CPI data release comes out here on, looks like it's April 13th at 8:30 a.m. And we're looking forward to that CPI data coming in lower month over month to show like, hey, month over month, we're not seeing the inflation you're expecting to see. We shouldn't be worried about what's happening. The CPI doesn't account for everything that we know, but there are a lot of hidden forms of inflation. Like obviously, look at asset prices. They're overinflated. That's really a lot. Real estate's been going up to the moon. Tech stocks might be inflated because since March till now, till 6 weeks ago, they just went up like there's no tomorrow. They never looked back. Real estate lumber, again, there are a lot of things that are going up through the moon. And so the thing is, if it had inflation, just go and buy Bitcoin. Deflation, central bank decentralization, baby. It goes up, you buy Bitcoin. Oh, to the moon. So supply chain issues is really important because there's a freaking ship that's stuck in the Suez canal doing nothing because its bow is stuck 30 feet under the floor of the canal and it can't move. Now you're talking about this will take like 10 days to move, and on CNBC they just said it might impact the global economy. It already started just because the ship was stuck. So this is much more of a crisis, and the longer it goes, it appears why. Because what happens is not that freaking ship, it's all of the other ones that can't use the canal because it just closed it. So to go from the Red Sea to the Mediterranean Sea, and where we live in Lebanon, you can't get goods and supplies from India and China through to Middle East and up the Mediterranean into Europe and then wherever to the States or South America or anything, and vice versa too. So you've got to, like 600 years ago, literally go make the whole perimeter of Africa, which is like 6,000 miles more. And to do this by boat, it takes 18 days more. This is absolutely bullcrap. 6,000 already takes forever for these container ships to get around. They're not exactly like the fastest things. I mean, they drive it like 14 knots, probably 6,000 miles. If you add it adds a lot of time. So if we do the math, get 6,000 miles and you divide it by 14. So it's speed divided by, it's distance divided by speed. Yeah, that gives 428 hours divided by 24. Yeah, you just added 18 days. You just added 3 weeks to your commute time to some of these products. That's crazy because it's not just in this ship that's important. It's actually the whole traffic, the whole commerce, how it's going to happen. Commodities, you have stuff like coffee, maybe not coffee, but fresh stuff, obviously, but you got food, commodities, iron, ore, chips, peppers, computer parts, things, maybe chips, battery chips, anything. The word is like, we need more of these. We want to buy more because real estate prices are so high. You don't want to buy a house, you want more computers, you want to invest, buy stuff, let's get a new gaming computer, let's get Beats, let's get anything. Or you might want just ants miners to mine more crypto, Bitcoin, Ethereum, or actually, I'll put the link down below if you want to mine more Pi. You just use my code, you get a free Pi, I get a free Pi in a faster rate, that would be awesome. So, whatever, right? You just need the canal for stuff to go faster. You want to build more cars. I mean, NEO, they're shutting down the facility for 5 days starting from 29th of March because of that. And now they can't reach their estimated 20,500 cars. They're going to be stuck at an estimate of 19,500 cars produced this year just because of that facility that they're going to shut down. They can't get their hands on enough chips. They have a shortage and they need more. And now that semiconductor will, imagine how the rest of the world feels now. They're in this position and you got a supply chain. Oh, sorry, I had 3 weeks to recommute. Yeah, oops. So why this is potentially really bad when we come back to bond yields going up and inflation and all. My expectation here has been that we're going to see lower month-over-month inflation data, and that's what was happening. Jerome Powell was doing what he said he was going to do. And now we're going to see substantially higher inflation. And so, yeah, we're going to see lower month-over-month. That's what we thought. But despite the fact we're going to see larger, substantially higher year-over-year inflation data, that's because we were in a pit in the pandemic in March. So it makes sense year-over-year. It's going to look a bit rough. You know, you won't be surprised. I wouldn't be surprised at all if we might go to like 3.5%, maybe 3.3%. I mean, compared to Lebanon, that's nothing. We're like 200%. It's absolutely crazy, not more. So I shouldn't really care about that. People are being freaked out because the media is gonna, oh my gosh, I just 3%, my money lost 3% of its value. Put in the S&P 500, get a 7.5% approximately. Yeah, you got this 4.5% more. Yeah, so it could literally jack up inflation because of this canal, because not only it's going to get more expensive, products are going to make more expensive, but because everything is going to get delayed, which means people want their products sooner. They're potentially going to be willing to pay premiums for these prices and they're to get them passed on the consumer, which is going to be very likely show up in the CPI, Consumer Price Index. And yes, we can literally see bad stuff for the CPI inflation for March, especially because of this bull crap. So you're going to now see the suits at Wall Street saying, oh my God, that's inflation. This creates a giant cluster of problems because now you have hedges and the funds, the suits, they're going, okay, cool, we did our rotation for the quarter, great, recorder is coming close, so this is our last Friday of the quarter of March, so quarter 2 starting soon, quarter 2, quarter 3, 2. It's possible that hedges and suits could even get more defensive now because of what happened. Well, actually, because to get out of higher multiple stocks even more Monday, Tuesday, Wednesday of next week, so prepare for a market crash that might get worse. Now, I'm looking for a good catalyst here. The problem is all we might have now is this bad catalyst, and it literally screams inflation. You see a picture of that ship on the newspaper, just see inflation, CPI very high. That's what you see. Okay, there's no good news about that. So this is long-term inflation or short-term inflation. We talk about this all the time on the channel. Obviously it's short-term, and like really short-term supply chain constraints are short-term, which means you have to bear through the house of pain that much longer, which means if you need basically what's now a mental health support group for, no, I'm just kidding. So, no, that was just a go. So, point here is, folks, that the ship could very likely, unless this gets broken free this weekend, could very likely cause a spike in inflation on a month-to-month basis that could potentially lead the bond market to freak out again, sell off on the bonds, sends yields up, yields go up, and if they go up too quickly, then you know what's happening to Tesla and NEO and tech stocks. That was too quick of a jolt, the acceleration of rates going up. I made an analogy earlier on previous videos about how it happens. Like you're driving a car, you go at say 65 kilometers an hour, then goes up to 80 miles an hour, you're in the back seat. Now you don't notice because the creep of bond yields potentially, right? But if you're at 65 miles an hour and somebody's like a 100 Model X and they zip to 90 or even 80, you just do so very quickly. You notice because you're like, whoa, that was too quick. So if you go gradually, that wouldn't be such a problem. Or if we're gonna go up, the sell-off is gonna be like really quick overnight, and then overnight you go from 1.8% to 2.5, 2.6. Yeah, that's gonna be dangerous. It's gonna be bloody, and it's gonna be because of a bull crap reason. So we should try and get over this whole bond yield thing, because it's something that I've easily seen coming. Not a big deal, but it came a little too fast, and it's been pretty volatile. We had a ship stuck in the Suez canal. Still can't believe you can. I swear, sometimes I wonder if this stuff is scripted. Bottom line is, you got to be prepared for inflation, bond yields up, and maybe stock market crash again. So, as fun as it is to buy the dip, question is, when is this freaking dip done? Because you buy a dip, you get another one. You buy the other dip, oh, you get a third one. You get a third dip, oh, there's a fourth one. Come on, we're just getting started. Yeah, so that's maybe we'll see. Hopefully this thing is going to be resolved quickly. We're not going to see a lot of things on inflation, because I mean, even though it's short term, if we bear through it, we're going to stay profitable. That's our concept of investing. But yeah, sometimes I think this whole thing is written. You can't write this stuff. Sometimes I just think it's scripted. But yeah, that's it for today. If you enjoyed the video, hit the like button, subscribe to the channel if you haven't already, and folks, hope to see you next time.